Welcome to Module 2 of the OC Insurance Academy Life, Accident, and Health Insurance Pre-Licensing. In this lesson, we'll begin exploring one of the most important products in the insurance and life insurance. You'll learn why life insurance exists, how it protects families, and the differences between term life, whole life, and universal life insurance.
Life insurance provides financial protection for the people who depend on you. When an insured person dies, the policy pays a death benefit to the beneficiary. This money can help replace lost income, pay off debts, cover funeral expenses, pay for children's education, and provide financial stability during a difficult time.
For millions of families, life insurance provides peace of mind and financial security. Life insurance works through a simple agreement. The policy owner pays premiums to the insurance company. In return, the insurer promises to pay a death benefit if the insured dies while the policy is in force. This agreement creates financial protection for the beneficiary. Every life insurance policy includes 4 important parties. The policy owner owns the contract and has the legal rights under the policy. The insured is the person whose life is covered. The beneficiary is the person or organization that receives the death benefit. And the insurance company issues the policy and pays covered claims.
Term life insurance provides protection for a specific period of time, 20 or 30 years. If the insured dies during the policy term, the beneficiary receives the death benefit.
If the insured survives beyond the policy term, coverage generally ends, unless the policy is renewed or converted, depending on the policy provisions.
Term life insurance usually offers the highest amount of coverage for the lowest initial premium. It is often chosen by young families who need affordable financial protection.
Whole life insurance provides permanent protection. As long as required premiums are paid, coverage generally remains in effect for the insured's lifetime.
Whole life policies also build cash value over time.
The cash value grows on a tax-deferred basis, according to the policy's terms, and may be available through loans or withdrawals, subject to policy provisions. Whole life policies generally feature level premiums that remain consistent throughout the life of the policy.
Universal life insurance is another form of permanent life insurance. It provides greater flexibility than whole life insurance. Depending on the policy provisions, policy owners may have flexibility to adjust premium payments, in some cases, the death benefit. Universal life policies also accumulate cash value. This flexibility makes universal life insurance attractive for individuals whose financial needs may change over time. Let's compare the 3 major types of life insurance. Term life provides temporary protection and generally has the lowest initial premiums. Whole life provides permanent protection with guaranteed cash value growth, according to the policy. Universal life also provides permanent protection, while offering additional flexibility for policy owners. There is no single policy that is best for every client. A young family may benefit from affordable term life coverage. Let's examine these distinct options. A client focused on lifelong protection and cash value may prefer whole life insurance. A client who values flexibility may choose universal life insurance. Your role as a licensed insurance professional is to help clients understand their options and select coverage that fits their financial goals. Here's an important licensing exam tip. If a question asks which policy offers permanent coverage and flexible premiums, the correct answer is universal life insurance. Let's review our first question. Which type of life insurance provides coverage for a specific period? The correct answer is C, term life. Now let's look at question number 2. Which policy builds guaranteed cash value? Remember, this is a key feature of permanent coverage. That's why B, whole life, is correct. Whole life, B, universal life, C, term life, D, group life. That is correct. Universal life is the right answer. Let's look at question number 4. Who receives the death benefit? Is it A, B, C, or D? Yes, in the back?
The beneficiary.
That is correct. It is the beneficiary. Excellent work. In this lesson, you learned the fundamentals of life insurance and explored the 3 major policy types. You now understand how life insurance protects families The roles of the policy owner, insured, beneficiary, and insurer, and the key differences between term life, whole life, and universal life insurance.
These concepts are essential for both your state licensing exam and your future success as an insurance professional. Congratulations on completing Module 2, Lesson 1.
In our next lesson, we'll explore policy provisions, beneficiary designations, ownership rights, premium payments, and other important life insurance concepts that every licensed insurance professional must understand. Thank you for learning with OC Insurance Academy. We'll see you in the next lesson.
In today's lesson, we'll explore the important provisions found in life insurance policies, learn about beneficiary designations, understand policy owner rights, and review premium payment options.
These concepts are essential for both the state licensing exam and your future career as a licensed insurance professional.
A life insurance policy is a legal contract. Within that contract are policy provisions that explain how the coverage works.
These provisions describe the benefits, responsibilities, rights, limitations, and conditions of the policy.
As an insurance producer, you should understand these provisions so you can explain them clearly to your clients. A beneficiary is the person or entity designated to receive the policy's death benefit. The primary beneficiary receives the proceeds first.
If the primary beneficiary dies before the insured, the contingent beneficiary is next in line to receive the benefit. If no living beneficiary exists and no alternate arrangements have been made, the proceeds may become part of the insured's estate, depending on the policy and applicable law. There are two common types of beneficiary designations. A revocable beneficiary can generally be changed by the policy owner without the beneficiary's permission. An irrevocable beneficiary has a vested interest in the policy. Once designated, changes generally require the beneficiary's written consent.
The policy owner controls the policy. Depending on the policy provisions, the owner may change beneficiaries, borrow against available cash value, assign ownership rights,
select settlement options, or surrender the policy. It is important to remember that the policy owner and the insured are not always the same person. Premiums keep the policy in force. Most insurers offer several payment options, including monthly, quarterly, semi-annual, or annual payments. Many companies also offer automatic electronic payment options to help prevent missed premium payments. A grace period allows the policy owner additional time to pay an overdue premium. During the grace period, the policy generally remains in force. If the insured dies during the grace period, the insurer generally pays the death benefit after deducting any unpaid premium, subject to the policy terms.
If a premium is not paid before the grace period expires, the policy may lapse. A lapsed policy no longer provides coverage. Many policies allow reinstatement within a specified period if certain conditions are met. These conditions often include interest and satisfactory evidence of insurability. Permanent life insurance policies that accumulate cash value may allow policy loans. The policy owner can borrow against the available cash value. Any unpaid loan balance, including interest, generally reduces the death benefit if it remains outstanding at the insured's death. Let's look at a practical example. After welcoming a new child, a policy owner updates the beneficiary designation to reflect their growing family.
They also enroll in automatic premium payments
to help keep the policy active. Regular policy reviews help ensure that coverage continues to meet changing financial needs.
Here's an important exam tip. If you see a question asking which beneficiary cannot generally be changed without consent, the correct answer is an irrevocable beneficiary.
Question 1. Who has the right to change a revocable beneficiary? A. Insurance company, B. Beneficiary, C. Policy owner, or D. Underwriter.
What is the purpose of a grace period? To provide additional time to pay a premium while coverage remains in force. Let's see who got it right. Which type of policy may allow policy loans? C or D, credit life insurance? The correct answer is B.
All right, let's review question 4 on the board.
If a policy lapses, coverage generally does what? The correct answer is B. Coverage ends unless it's reinstated. This is a crucial point for your exam. Excellent work! In this lesson, you learned how policy provisions define the operation of a life insurance contract. You explored beneficiary designations, policy owner rights, premium payment options, grace periods, reinstatement, and policy loans. These concepts are essential for helping clients make informed decisions and are frequently tested on the Life, Accident, and Health Insurance Licensing exam. In our next lesson, we'll explore life insurance riders, optional policy features, and how these valuable additions can help customize coverage to meet a client's unique needs. We'll see you in the next lesson. Thank you for learning with OC Insurance Academy. We'll see you in the next lesson.